Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please read through our important disclosures being shown now on the screen. These and additional disclosures regarding the risks involved in the types of investments we will be discussing can be found on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates on Crescat's activist metals positions, both positive and negative news across our holdings as it arises. The discussion and topics will not cover all aspects an investor should consider when deciding whether or not to invest in any of the securities that are part of our presentation. The type of investments that we discuss can carry significant risks, and whether or not to invest should be a determination made with the complete investor suitability in mind and in connection with a professional advisor. The topics and themes we will discuss are the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our strategy in creating new economic metal deposits in viable mining jurisdictions around the world. The forward-looking business opportunities we discuss may not come to fruition or may not have a significant impact with respect to the value of a security. The presentation should not, under any circumstances, be considered investment advice or an offer of investment advice or services. Crescat's managed funds only will accept accredited investors, and this presentation has generally been put together with that level of audience sophistication in mind. Any securities discussed do not represent a full portfolio and may only represent a small percentage of any strategy's holdings. These securities may or may not be held in any Crescat managed portfolio. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick. His contact information is on the screen now and can also be found on our website at crescat.net. Phew. So with all that, let's get going. I'm just going to be going over today a basic refresher on Crescat's investment strategies and some of our core themes, and I'm going to talk about some of the past ideas that we've had that have been leading to the performance that we're experiencing year to date. Tavi will continue with a macro presentation, and Quentin will continue from there with the activist metals updates on our positions, with the various news and so forth. And so let's get going. So this is, Crescat's three hedge fund strategies are our global macro fund, our precious metals fund, and our long short equity fund. And there's really a lot of overlap with these strategies. The global macro fund is the most comprehensive strategy that we have. It's our flagship fund, and it has exposure to all of our various macro themes, including the activist metals theme. And so if you look at it, it's like concentric circles or a Venn diagram, because the global macro fund is the one that encompasses everything. The precious metals fund, that's really our long natural resource equity fund, our long precious metals and base metals fund. It's predominantly precious metals mining oriented, and heavily tilted towards the exploration side of things, because that's where we believe the biggest opportunity is in the market right now. And then the long short equity fund is really the equity only long and short component of our global macro fund, but at the center of all of it, the intersection of all of it today, the biggest theme across all three funds is our activist metals portfolio, and it's one of the most exciting things that I've ever been involved in my 30-year career so far in the investment industry. Let's go on to the next. If you think about the Crescat's investment process, our values, and who we are at the center. We are macro, and we are fundamental value-oriented investors. And to accomplish our objectives, we use quant models. We work with industry experts like Quentin on the metals front, and we employ this thematic approach. So we have big picture macro themes that drive how we think. They're supported by the quant models, by the fundamental analysis. And when it comes to risk management, this is very important to point out, because as value investors, we embrace volatility in order to realize the intrinsic value, in an attempt to realize the intrinsic value of our holdings. We both on the long and the short side of our portfolios, we want to be short securities that are heavily overvalued, and we want to be long securities that we believe are extraordinarily undervalued, and of course have catalysts to drive that appreciation towards value on the long side, depreciation towards value on the short side. But in order to do that, we do need to be able to embrace some volatility, and sometimes that can really work to our advantage when the portfolios are performing. But when things aren't working, there's risk and there's downside too. But we're grounded by the intrinsic value in what we believe in, and that's what gives us the confidence to be able to ride through that volatility even when things are down. Let's go on to the next. So year to date, Crescat is having a great year across all three of our hedge fund strategies. The long short fund is the number 2 fund in the entire Preqin database right now of global hedge funds. 873 funds have reported so far through their March performance. Long short fund net of all fees is up 60.4%. That's our ex-side pocket performance for those investors who've been with us a long time. They know that we have a private company investment in San Cristobal Mining that we placed into a side pocket back at the end of June of last year. And so new investors coming into the fund since that time are not able to participate in San Cristobal. San Cristobal has been a big success for us, but unfortunately, new investors don't get to participate in that. But this is the performance that new investors coming into our funds have been able to participate, as well as existing investors. It's the rest of our fund outside of the San Cristobal side pocket. We call it the X-side pocket performance. The Global Macro Fund is up 58.7% net through March of this year. That's the number 3 performing fund in the entire Preqin database. And the Precious Metals Fund is number 6, up 36.8% net. We are outperforming our benchmarks. We are among the top 10 performing hedge funds year to date, and March and in April, month to date. Things are going well too. All of our funds are up in April month to date. So let's talk about what's been going on, how we've been able to accomplish this. Let's go on to the next. So we have written ad nauseum over the past couple of years about what we believe has been a bubble, brewing in large cap tech stocks, the Magnificent Seven. This is a chart from our letter a few months ago, and we're just we have been talking about this bubble. We still believe it is a bubble that has only begun to burst and is still in the process of bursting. But in our funds where we've been short, that's the Global Macro and the Long Short Fund. This has been a key profit driver year to date for us. We have been short the Magnificent Seven. We've been short the S&P 500, the NASDAQ 100, and various stocks within the Magnificent Seven, Apple, NVIDIA, Microsoft, and we have been having positive attribution, across all of these positions year to date, including month to date in April. And let's keep going here. Well, let's stop for 1 second, Trevor, because the point here is that these top 7 stocks reached over 60% on an enterprise value, collectively enterprise value to GDP basis, and historic level of market cap relative to underlying GDP. And it's simply it's an unsustainable valuation. The growth of these companies going forward, in our opinion, does not justify this level of valuation. And on a comparable basis to other market tops like the tech bubble peak in 2000 and like the 1929 stock market top, these are very comparable valuation extremes. Let's go on to the next. This is looking at in the tech bubble, the top 10 tech stocks in the tech bubble only got to 30% enterprise value to GDP. The Magnificent Seven got to over 60% EV to GDP. Look what happened in the tech bust in 2001 and 2002. These stocks just absolutely collapsed. I mean, down like 80%. And we think something comparable is setting up today. Let's go on to the next, and it's only begun. I've produced this chart. I mean, I've taken a lot of flack over this chart from trolls out there who think I was out of my mind in making this kind of comparison. But this is comparing NVIDIA to Cisco. So Cisco Systems at the peak of the 2000 tech bubble was the largest market cap company in the world. NVIDIA, not quite the largest market cap company in the world. That's Apple today. But the comparisons to Cisco, I think, with NVIDIA are apt because because NVIDIA is the company right now that is the infrastructure darling in terms of, back then it was Cisco routers. Today it's NVIDIA microchips. It's the hardware that all the other hyperscalers have been buying, and it's an unsustainable valuation. NVIDIA has unsustainable margins, unsustainable growth rates. There is competition out there. NVIDIA has started to come down. NVIDIA has been one of our shorts recently that we've been making money on. But this is a chart. I don't have an updated chart on this. It's one that we published a few months ago. I'm just reminding you of this. Let's go on to the next. This is really putting it into context, okay? Now we're looking at the top 10 mega cap tech stocks back from 2000 versus the top 10. Recently, this was the chart we published back at the end of October. And yeah, it went a little bit higher from those end of October levels, but put it into context. These companies have become so big in valuation, profits, profit margins, growth rates, all of that. I mean, all of the, you might think the valuation is justified because the fundamental growth trajectory has been strong, but it's not sustainable. The margins are not sustainable. The growth rates are not sustainable. These companies have become too big and too big of a bubble, to justify their future growth. And now we have catalysts. We have catalysts with the economic rebalancing that the Trump administration is trying to accomplish. That is in the process of bursting these bubbles, in my opinion, in our opinion, and they have only begun to crack. Let's go on to the next. So why do we like gold and gold stocks so much? Gold for us is a macro trade. It has been a macro trade, but as value investors, we want to figure out where's alpha. How do we get the alpha to gold, the outperformance relative to gold? and that's why we have gotten together with Clinton and built this activist metals portfolio, because we believe there's extraordinary alpha to come from the mining sector, from the mining stocks, and especially from the smaller cap mining stocks that have the big new discoveries, and that we're helping to make the big new discoveries of gold, silver, copper, zinc. But this is looking at the 1929 stock market peak, their valuation comparisons today with the S&P and the 1929 peak. We have made these comparisons, ad nauseum in our letters over the past few years, but it's finally starting to unfold. But what happens in certain types of markets when gold and gold stocks are cheap and starting to break out at the same time as the stock market is correcting? You can have these counter-cyclical moves where gold and gold stocks are the place where money is rotating into, okay? And you can go back and read our letters. I'm not going to get into all the detail of this chart, but home stake mining, during the Great Depression, went up substantially at the same time as the Dow Jones and the S&P 500 were collapsing from record bubble valuations, from tariff trade wars, and which was the catalyst, for some of that back then as well. But let's keep going here. 1973, 74. Yes, we've shown this before ad nauseum, but this is the type of setup we still have today. And in 73, 74, you had the nifty 50 mega cap tech stocks and other mega cap growth stocks of the day collapsing. Again, something like 80%, 70 to 80%, those nifty 50 stocks went down, the top 50 market cap stocks of that time frame. The S&P 500 went down about 50%. At the same time, in just 2 years, at the same time, you had a rip-roaring gold market. Of course, Nixon had taken us off the gold standard, but look at this. The Barron's Gold Mining Index went up 376% from November 1st, 1972 to August 16th, 1974. At the same time, the S&P 500 was down 34%. So you can have these markets where gold stocks are going up at the same time as the overvalued mega cap tech stocks are coming down. This is the environment we think we are going into. For us, this is just a right down the middle of the fairway kind of a trade: long undervalued gold mining stocks, short overvalued S&P 500 stocks, and we think it's still early innings. This is how we've been performing year to date. Let's go down to the next. The tech bubble in 2000 is another similar period where you had big, large cap tech stocks collapsing at the same time as you had the beginning of a major bull market for mining stocks. We're coming off of such depressed levels for mining stocks at the same time as gold is breaking out. It's still very early innings, we believe. Look back here from November 13th of 2000 to March 10th of 2008, the XAU index, that's the Philadelphia Gold and Silver Mining Index, the large cap miners, rose 390+% at the same time as the NASDAQ composite was down 27%. That's over like a 6 or 7 year period. Okay. Again, this is a type of setup we believe we have today. Let's go down to the next. Apologies that this is so small, and you can go and read this in our past letters. This was from a letter just a few months ago. This is, again, talking about the counter cyclicality of mining stocks versus the S&P 500. And, people think people are still so afraid that we're going to have another 2008 type of a stock market where mining stocks correct at the same time as the S&P 500 goes down. But what we're looking at here in the yellow line is the S&P TSX Venture Composite Exchange Index. So what the heck is that? It's about 100 plus stocks on the TSX Venture. A number of our companies and the mining stocks that we're long are listed on the TSX Venture Exchange. It's the exchange where most of the exploration stocks will list, and the TSX Venture Exchange Index is like the top 100 plus of these stocks in market cap. A number of our companies, about 5 of them that we own, are in that kind of top 100. But we have a number of other, ultra depressed valuation companies relative to the big metal discoveries that we believe they are onto. And but this is showing how depressed the exploration segment of the mining industry is. This TSX Venture Composite Index is heavily comprised. More than 60% of the companies in this index are exploration-focused miners. Now, this was, from several months ago, back at the end of October, we produced this chart, and the venture index is up from those levels, but it's only just started, in my opinion, in our opinion. But why is this not like 2008? Why in 2008 there had already been a more than 400% run up in the S&P Venture Composite Exchange Index? Okay, then 2008 hit, and it gave back literally everything. There was another run up into 9 and 10, and we've been going through like a 14-year, 15-year bear market and consolidation ever since, at the same time as the S&P 500 has just been ripping higher and higher and higher. Okay, this is the setup today. Deeply undervalued precious metals mining stocks, especially in the small and micro cap arena. This is where we're focused, because this is where we can create alpha, extraordinary value, by creating discoveries, helping our companies get money to drill and to make big new discoveries. The major mining companies have underinvested in exploration and discovery and new mine development for the last 14 years, ever since that intermediary peak in this index back in 2010. There's been no money going to exploration. I mean, there was in 11 and 12 a little bit, and it's been dead ever since. Starting to come back. Crescat is trying to be at the forefront, at the lead of that, and getting money to the best management and technical teams, the best explorers out there to do the drilling, to make the discoveries. The setup is tremendous still today. It's still extraordinarily early in the cycle, we believe. Let's go down to the next. So what is our activist metals strategy all about? What does activist investing mean for Crescat? It's about identifying large-scale gold, silver, copper, and other critical metal discovery targets in viable mining jurisdictions. We want to acquire significant early-stage stakes at low valuations through PIPE investments and pre-IPO rounds. PIPE, what's that? That's a public that's a private investment in a public equity. We can negotiate deals. We can come in at a discount to the public stock market price. We can get warrants for our clients. And trust me, in the last couple of months, as we had this little blip down in the mining industry, in the junior industry, we've been negotiating a lot of new deals. We negotiated about 20 new deals that we have closed over the course of this month, and will be closing over the course of next month. We are putting money to work amongst our companies and amongst some new stories that we have too. Our goal is to inject capital into these companies for exploration, drilling, and development work. We provide activist-oriented geologic and technical advice. That's primarily coming through Quentin. We help place management and directors in certain circumstances. We help build the geologic and technical teams, and we share the story with the broader investment community. We'll be doing that again here today. Let's keep going. So here's some important disclosures regarding our activist metals portfolio in the slide that's going to come up next. The activist metals portfolio, it consists of our firm-wide holdings across all of our funds and SMA accounts, and it's what we've been talking about, the investing in building new economic discoveries through exploration and drilling, and our target resource estimates here are estimates that are done by Quentin and as a geologic and technical expertise. He's a PhD from the Colorado School of Mines with 40 years of mining experience, including with the majors and a number of different smaller exploration companies. And Quentin is responsible for many major gold, silver, and other metal discoveries throughout his career. You can read this at your leisure, but we do have disclosures. This is in our deck on our website as well. Let's go on to the next. Let's get into some of the meat of the statistics around our portfolio. Okay, so we have 70 positions currently in our activist metals portfolio. And this is, our modeling that we do around the portfolio is based upon the current metal prices. We do believe metal prices will be going higher. One thing of note to point out here is the gold to silver ratio. So if you look across the top of this slide from left to right, we're looking at current gold prices around 3,300 plus, silver prices around 33.5 per ounce. The gold to silver ratio is about 100 to 1 today. This is a record high level of gold to silver ratio. Tavi will talk about the gold to silver ratio, I'm sure some. But normally when you get into a bull market and gold goes up, the gold to silver ratio comes down. We haven't even seen that yet. Silver has an extraordinary catch-up potential relative to gold. There is extraordinary value in silver today, and we have a lot of silver in our portfolio. So we got 70 positions. 38 of those companies have bona fide discoveries already. What does that mean? That means 3 or more 100-gram meter drill intercepts on a gold equivalent basis. This is criteria that we learned about from Quentin, that when he was working for Newmont, that Newmont used this as their criteria for what's a bona fide discovery. And these are the types of companies that they would put on their watch list for potential acquisition. 38 of our companies have these bona fide discoveries today. 18 of our companies are still private companies. The rest are all public companies. We have 34 positions where we own greater than 5% of these companies on a partially diluted basis. What does that mean? It means including warrants. If we were to exercise, we own outright stock, plus we have warrants. And if we were to exercise our warrants, we would be over 5% ownership in 34 of our companies. At the median among all 70 of our companies, we own 11.7% of these companies across our funds on a partially diluted basis. So 99 drills. What does that mean? We have 99 drills operating across our entire portfolio. That's more drilling than all the major. That's more greenfield drilling than all the major gold mining public companies out there today. Quentin can probably talk about that a little bit more. And based upon Quentin's geologic estimates, we, across our portfolio companies have 263 million of target gold equivalent ounces. That's across silver, gold, copper, nickel, zinc, manganese. But this is the level. Quentin's growth targets for these companies are even higher, but based upon the drilling to date, this is the amount of ultimate resource that he believes our companies will be able to deliver. that's more gold equivalent target that then is owned by the U.S. Treasury, which is the largest owner of gold of any single entity on the planet. The point is, these are big targets. We are about going big and allocating capital to an industry that has seen no capital. And the goal is to make big discoveries because the majors have underinvested. We do believe there's an M&A wave coming, and it's already started. Let's go on to the next. What happens when a major mining company buys a gold explorer? Well, on average, they pay 17% of the resource value of the metal in the ground based upon what the published mineral resource is within 1 year after the acquisition. Okay, 17% at the median. Bull markets, they pay more. In neutral markets, 17 is the median. Bear markets, they pay less. We think we're going into a bull market. It's only just started. The valuation of our companies, I can't tell you what it is because it would be too unbelievable how cheap we think our companies are relative to the 17% target. We're value investors, so we love to acquire things deeply undervalued that have big price targets. And I don't want to overhype it, but we believe that our companies are substantially undervalued relative to these acquisition targets, and acquisition is one of the catalysts we think for our companies. Let's go on to the next. Looking at our precious metals fund, we launched this in August of 2000. It was actually a temporary peak in the gold market at that time, and we had a huge run in just the first 8 months of the strategy. We've been through a long consolidation, and we're starting to really pick up and run again. Now we believe there's a lot more upside ahead. But net of all fees, and this is the X side pocket performance, so it doesn't even include San Cristobal. If you include San Cristobal, the returns are even higher. But the fund has delivered in its since March of 2020. Since August of 2020, it's greater than 4 years now of performance, annualized performance, 23% net. That's beating all of the benchmarks. The Philadelphia Gold and Silver Index, the large cap miners, the GLD, which is just gold itself, the GLD Trust, the Silver Trust, the Van Eck Junior miners, which is a misnomer because they're really mid cap producers. They're not explorers. We own a lot of explorers, and I hate the word junior. That this industry loves to call the small cap stocks and the micro cap stocks the juniors. They like to call the explorers the juniors. I don't know why I hate it, but it just sounds so demeaning because these are companies that are spending the money to drill out and discover the new big gold, silver, copper discoveries around the world. The stuff that the world needs, the stuff that the world wants, the stuff the new Trump administration wants. And anyway, people like to demean them and just call them the juniors, but okay, whatever. These are big gold discoveries that we are investing in and trying to create. But the junior mining ETF, GDXJ, that's not even the real explorers. Those are mid-cap producers. We own the real explorers. And then you have the Van Eck, the GDX, which is another large cap index, kind of like the Philadelphia. We've been outperforming all of them since inception in this fund, and I think we have a lot more to outperform in the months and years ahead. I'm just about to finish up here. Let's go on to the next. Maybe that's it. All right. It's time for Tavi.
Sorry, I'm muted. Thank you. All right. Well, let's talk about a few things. Presentation will focus on a few things regarding macro views that we have. And I really like this chart. I think it's reflective of a thesis that has been building at least for the last few months, in fact. And you can kind of see how these types of ideas, they sort of have a chapter to them over time. And it was inflation when we came out of COVID, learning about the history of pandemics in the past and how you tend to see this inflationary cycle after those lockdowns and so forth due to supply and all sorts of things. Then you had, after the policy response, you had this issue with interest rates that had a risk of rising substantially, particularly in the long end, the 10-year and the 30-year, because of the issuances of treasuries. The next chapter of this, in my view, was sort of this yield curve inversion. Well, initially was the inversion, and then we had the disinversion period that also occurred already. And then next after that was this whole thesis about the dollar, the U.S. dollar, of which wrote a letter back in the very end of 2024 about the bear market case for the U.S. dollar, and we saw sort of a moment where the dollar actually surged after that conviction view started to brew, and to me, when I at least see prices going away from a view that I have, it doesn't scare me. In fact, if there's enough reasons, fundamental reasons to believe in that thesis, I would say that it's only a blessing actually to be able to express that opinion at a better market position. And I would say that kind of leads to this next chapter as we see the dollar being more challenged over time. This is not a short term, not a next week and not next 2 weeks type of idea. This is something I believe will occur over 5 to 10 years as the administration is in my view, almost compelled to allow the dollar to devalue over time. But the second pillar of that idea is the 2-year yields, is the suppression of yields in a big way. Clearly the administration has two goals. Is the problem with the chronic deficits in two things. In the fiscal side is the fiscal budget deficits that we're running for so long, which exponentially grows the debt, but also the trade balance is the issue with tariffs and all sorts of policies now created to try to accomplish the goal of reducing the amount of imports relative to exports that we have. I don't know how you accomplish those things without drastically reducing the 2-year yield and also the dollar in terms of the valuation of the dollar. And this chart, what is looking at is two important things. It's looking at growth in GDP terms in real terms in the U.S. versus the 2-year. The 2-year yield to me is way more critical than the long end of the curve. And the reason for it is because majority of the debt, when you look at the duration, the maturity average of the treasury outstanding is below the 5-year yield. And the 2-year yield becomes this critical and far more strategic part of the treasury curve that I view as a potential to fall substantially, given the need that we have to reduce also the deficits, and interest payments is a huge portion of that. So as you can see here, I'm looking at one thing that is called the Fed Atlanta GDP now, which a lot of the macro guys would know what it is. It's basically the Federal Reserve trying to predict where the Fed growth would be quarter over quarter in real terms. And right now it's predicting that it's going to see a substantial decline quarter over quarter. Then I took that number and I wanted to see this year over year, because that's the chart you're looking at, is adjusted on an annual basis. And that's, mathematically right now, if you look at this number, it should be actually trying to predict that, or the Federal Reserve is basically estimating that the economy would actually be growing on a year-over-year basis by almost a little shy of 1%. Now, there's been a big impact on this number that came from the large amount of imports of gold. If you include that, it's slightly higher GDP growth, a little over 1%. But you can see that when you have this situation where real GDP growth starts to fall in terms of the growth, and it gets into even a point of contraction where it's shaded in the red lines, i.e. a recession, you tend to see the blue line, which is the 2-year yield, fall substantially. To me, that's one of the biggest views, at least that I have in terms of conviction, that is yet to be part of the market. Again, that's just my 2 cents. If we go to the next chart and we just look back one cycle from here, the next chart, please. Can we go to the next chart? Sorry. Okay, there we go. You can see here that back in 2018 or so, we did see something similar. In 2018, if those recall, there was a big issue with trade wars between US and China. That sounds familiar. The Federal Reserve was being very stubborn as well in terms of lowering rates because of the issues that we were seeing. I think that's classic of today as well in terms of, I don't know if it's for political reasons. I don't want to get into that either. But clearly the Fed is waiting to see a substantial sign of the economy slowing down and even contracting before it acts. And so when you think about this, I mean, usually what you tend to see is the Federal Reserve rates, which is substantially now higher than the 2-year yield. It tends to invert with the 2-year yields as you see a contraction occurring. In other words, the 2-year yield tends to move ahead of the Fed funds rate. In some cases, or a majority of the cases, as you see the recession unfolding, by 2 percentage points. So in other words, you have the Fed funds rates, let's call it at 4%. The 2-year yields could be at 2 percentage points in that case. So you can see this big separation or dislocation between where Fed funds rate is versus where the 2-year yield is. And to me, if you look at the 2018 environment, the market did react in a negative way as the Fed was being stubborn, which caused the Fed keeping rates higher than what is supposed to be is usually what intensifies the downturn. And so, in my view, it's a similar scenario that we're seeing, and it's likely to unfold here as we see the economy having some more issues because of rates being too high on the federal interest rate policy. Let's go to the next chart. And you can see this as well in the economy itself. And most of the analysts have not really adjusted their estimates, which to me is a little bit shocking, actually. If you look at the Q2, we're entering Q2 now, earnings releases, and you compare that with the last Q2, for instance, which is what this chart is trying to accomplish, you can see that we're estimating, or Wall Street is estimating, an increase of about 11% in corporate earnings from a year ago. I'm not sure that's going to be really the case. It seems to me the estimates are very high relative to what we could see. I can certainly come up with a few reasons for why we can see a contraction of earnings. And perhaps this reminds me a little bit of the COVID impact that we had with the lockdowns and all these situations with the lack of shipping of goods and all that. I mean, we're seeing from big logistics firms basically saying that there has been a change in shipping of goods, and we may start seeing, I think Walmart had a quote as well claiming that we may start seeing those impacts showing on to the consumers in the next 3 weeks or so. If that's the case, and we start and companies are not able to sell their products because all these goods are actually stuck in other countries, given the tariffs and all the trade war negotiations that are occurring, clearly that could have an issue in earnings that I don't think it's reflected right now in the estimates. If you look a year out, or I should say, another year out, you can see that the number is substantially higher, and it's above 20%. And so I do think that seems overly optimistic relative to what we may be seeing here. If we go to the next chart, which has been totally, I perceived as a political, way of explaining the situation that we're seeing. U.S. airports are welcoming fewer international tourists. Is that really the reason? I don't think that. I don't know of many people, or maybe there are a few, but I don't know that the majority of people that are traveling less because of trade wars. I don't think that has much to do with it. I think that has a lot to do with companies actually cutting their budgets and doing less traveling for business reasons. I think there's a lot to do with consumers hitting a wall and also not spending as much as they used to I think it's much more reflective of a potential contraction in the economy, globally speaking, than actually a political reason for why people are not traveling. So I take a completely different take of the title of this chart, but the data is very useful, as I just presented a case of looking at corporate earnings and the estimates that are being implicitly shown by most of those Wall Street analysts out there. Let's go to the next chart. And the next chart is something, just a reminder. Berkshire Hathaway has piled on cash over the years. I've seen this movie before, where a lot of we call it less seasoned investors, younger people, especially that have been believers of even the digital market, the digital currency market, as another way to say the crypto space, and have just completely ignored the fact that you have such an intelligent and I would say a remarkable career and of Buffett's way of investing in holding as much cash as he has been holding. It's something that you should be at least aware and respect, rather than poke fun and say that the guy is just not as relevant as he used to be. I think this is it's an important sign. You can see this relative to his balance sheet as well. Clearly, he's holding a significant amount of cash because he's not finding new opportunities, and that's also reflective of how expensive things are in terms of valuations. Let's go to the next chart. And the next chart is a chart is something that is part of what I was referring to, and I'll get into. We talked about the 2-year yields and the potential for the decline of interest rates in the U.S., especially down the curve of the 2-year, in my view. But that should have an impact on the dollar. It's the fact. Remember that idea that the U.S. is spending close to 4 to 5% of interest payments to GDP, while Europe, for instance, or Japan are paying less than 1% in some cases. Europe is, I'm referring to the Euro countries, but if you look at Japan as a single economy, you've got it 0.9% of interest payments to GDP. So Japan is in a better position to raise rates than the U.S. It's a very unpopular view that, as you can see, if rates need to fall in the U.S., and they have to fall more than other rates elsewhere, that usually has an impact on FX. And hence why I think that if you look at the DXY index, which is one way to look at the dollar performance versus other fiat currencies, there is a potential that the dollar could fall much further. And then you look at this 10-year rolling change, we're just starting to get into that negative camp of that number, as you can see on the second panel of this chart, which is taking a 10-year performance of the dollar rolling over the years. You can see that a lot of times we see multiple years of that 10-year rolling performance in a negative front. For those that are more short-term thinkers, of which I am not, the 10-year, the second panel of this chart is completely meaningless for you. To me, it's extremely meaningful, because if I have a view that yields are going to be capped, most likely, and I also have a view that the dollar is at a situation where it needs to be devalued relative to other fiat currencies for trade balance issues, or just because things are way too expensive. I mean, we have a dollar that is as expensive as it was before the Plaza Accord. What does that mean? And I'll go to the next chart. And the next chart, I'm just showing euro breaking out. It's one example. These things, they take time to develop. When you show a chart like this of all the way back to 2006, and you see a breakout of the euro like this, these are very meaningful moves. And a lot of people tend to get very bullish on the euro after the fact, after you see a breakout and so forth. And to me, I think these things take time to, you're not going to see a straight line, just like any other asset. In the way these things behave is usually currency trends tend to take a long time. They usually very long term, ideas that tend to play out in markets, and usually they're linked to other things as well. And so keep that in mind. You have the dollar changing in a big way, potentially entering a long-term fall, or the euro entering a long-term appreciation potential. And the other side of it, you have interest rates being, challenged more and more to drop. That means that the next chart should be about where I also think there's opportunities, which is emerging markets. As we see the rebalancing, which we'll talk about this in a minute here, emerging markets are something that comes to mind because they're just incredibly undervalued, historically speaking. In many ways, you can look at relative to fundamentals. You can look at, in this case, it's a calculation of money supply. So you just look at the market cap of Brazilian equities relative to money supply, and you can see that prior times when those equities were as undervalued as they are today, it marked significant bottoms. There was the COVID crash or the Brazilian political scandal that we saw back in 2015, 2016 during the car wash, or the global financial crisis bottom, or even the early 2000s. And none of those bottoms are easy to call, none of them. And I'm not here to claim that buying low and selling high is an easy thing to do. It's extremely hard. And usually there are reasons why things are cheap. And that's not the point at all. I mean, these things are volatile, they're risky. However, there are moments where when things, are basically already implicitly, I guess, in the price in terms of the risk. That is my opinion. I think that's mostly in the price and a lot of those risks. And I believe that if you are entering a world where the dollar and yields are going to be challenged lower, I think that emerging markets, those are usually the big macro risks you have for investing in emerging markets. It's competition elsewhere, because the risk, structurally speaking, it's not like Brazil will change. When usually you show this chart, people will say, well, there's political risks and all that. I'm not claiming that's going to change. That will be the case 10 years from now, most likely. It's just the nature of an emerging market. Brazil has been an emerging market for 30 years. It's never emerged to become developed, and unlikely will become developed. And it's not that I'm picking Brazil in one way. I mean, we did an investment in Bolivia for 6, and there are other economies that look just as attractive in my view. I'm just picking one of them for the sake of the presentation. But let's go to the next chart, because if you recall, Scott Basson this week did a very important presentation where he talked about, well, the main word, I think the whole presentation should be about one word, which was rebalancing and trade fairness in terms of relationships between countries, and rebalancing likely to happen of the U.S. not being such a massive importer of goods. Okay, well, if we're going to see that, let's talk about the elephant in the room, which is this chart. It's the rebalancing financially speaking. It's the rebalancing of 73% weight of U.S. equities relative to else. There's no other country that has even double-digit weights today in MSCI World Index. And so I think that rebalancing is sometimes when you try to fix one issue, you basically could trigger other unintended consequences. And I think that by doing what the Trump administration, rightly or wrongly, doing in terms of the trade rebalancing that we're seeing, may actually trigger a rebalancing financially in terms of the weights of equity markets and also the currency aspect that I was talking about of the dollar being challenged. Let's go to the next chart. I'll try to get my skates on, so go quickly. And so you can see here, the gold to silver ratio had a big move recently. Silver was actually rising on a day that gold was falling. There has been a lot of attention over gold being overbought and maybe even overvalued. That is not my view at all. I don't think that's the case. You can look at gold relative to money supply. You can look at gold relative to treasuries outstanding. Gold has been an anchor for monetary systems for a long time. If we put, just a disciplinary hat and look at relative to other periods when we have monetary realignments, which I think we're facing now, it would suggest that that gold prices can see, drastically higher numbers, and that's just research of history. That's not, targets or anything along those lines. At the same time, it's very difficult to ignore the fact that we've had one of the biggest gold to silver ratio declines the other day. I think it was 2 days ago, on a day that gold was down substantially, and a lot of people focusing on the gold side instead of focusing on the silver side. And at that time, when we saw, it was October of 2008. That marked the beginning of the declining trend of the gold to silver ratio, of which that ratio went from a 85 all the way back to 30. That would imply, just to give you some sense, if we go to 30 on the gold to silver ratio, that would imply $110 of silver prices per ounce, just using the ratio. If we go to the next chart, we're going to look at the history of the gold to silver ratio. Again, there's two types of investors: those that look at this type of chart and say, well, this time will probably be different. There's reasons why the gold to silver ratio should be above 100. And most likely, we're entering a different era. I'm not a believer of that. I look at this chart and I think, all right, how many times have we seen this above 100? Do we stay there for too long? No, very unlikely. This is over 120 years of history. Okay, well, that's relevant. And at the same time, I have a view about gold. We have a view about gold. And also we have a view about silver. Silver has played a monetary aspect and has played a monetary role in the global economy many times in history, and could certainly play it again. And it's usually the case when things get too cheap, they become more industrial. And so it doesn't mean that it's a structural change of the demand of silver, but rather just the fact that it's just so cheap that it's being used industrially. But as you see silver prices increase, which is my view, and I think everybody else's views here, that changes. It creates a demand from a monetary standpoint. I think we're going to get into that world as we unfold here in the following years. Let's go to the next chart. I'm almost done, Quentin. This chart is just basically saying, what we've been seeing recently of gold prices rising. I think there's, you can create all sorts of rumors and think about logically what's been causing gold prices to rise recently. Well, number one has been central banks. They've been announcing they've been buying gold, and gold has been rising regardless. So I caution people that using technical analysis for when you're at a turning point in history of seeing a monetary realignment, which I'm using the term specifically from Scott Batson prior to becoming the Treasury Secretary in prior interviews, you can see clearly that people are rushing to buying the metal for other reasons outside of technicals. And so using technicals for trying to time 5 to 10% moves in gold up or down, to me it seems very irrelevant given the significance of history that we're facing right now. And it wouldn't shock me at all if the yellow line, which is in this chart, yellow line is showing the gold reserves by the U.S. and the blue line is showing the gold reserves by international central banks. It wouldn't shock me at all if the yellow line is the one actually causing gold prices to rise. If we think about it, that's just my view. If we think about it, clearly the U.S. administration is incentivized to see gold prices to rise. If we want to revalue gold or do something along those lines, which have been talked about also all over the media, in order to increase the collateral value of the TGA account and increase the cash balance of the TGA account, and be used for treasury buybacks and other things, the toolkit that Scott Batson has often mentioned. One way to do that is by seeing gold prices rise. And so I'm just saying that everyone is incentivized to see gold prices to rise. It's another reason why, to me, looking at overbought indicators, it seems a little bit irrelevant to where we are in history now. Let's go to the next chart. I think I'm almost done, if not done. But the other thing that comes to mind as well is this chart, because it's the catch up to gold. Gold has had a very big move, and a lot of commodities are extremely cheap relative to gold. And this chart is a good way to show that. It's not just oil, it's copper, it's silver, it's platinum, it's agricultural commodities. All these things are really cheap and usually are linked to gold. If you look historically, gold prices rise, they usually have a correlation with other commodities. It makes sense. Their natural resources are interconnected usually, and they have moves that tend to be balanced. And so I suspect that the catch up of other commodities is potentially or arguably an even more interesting idea than saying gold is overvalued, but rather that other commodities have some catch up to do here. I'm a firm believer of that idea as well. Let's go to the next one. I think I'm almost done. And last thing I wanted to point out, I guess, is the overvaluation of the S&P. I mean, I've shown a lot of charts just now, commodities to gold ratio. Look at the S&P 500 to gold ratio. How overvalued are we right now? Where are we again at a point in history? We're just as high as we were back in 2019, 1929, at the very peak of the bubble that caused the Great Depression, which was a time when tariffs were imposed later on, but maybe the market was acting ahead of some of those issues as well. I just want to point out that things are very frothy on the financial markets side of asset classes, and gold is extremely cheap from that perspective as well. So, anyways, that's just another way to see how the whole global economy is shaping up. I think it's the last chart. Let's see if that's true. It is. Go, Quentin.
Yeah, you can always tell the geologist. So, a lot of people, they look at spring and they think about spring flowers and all the nice, warm, beautiful skies that we have right now. But I think of one thing, and that's getting back out in the field and drilling holes. Yep, it's that time again. Okay, we're rapidly approaching the field season here in North America. There's going to be a lot of companies active again. I think the general trend I've seen here recently is that companies that have gone out for financing have been able to secure it, which is very unusual compared to the past 2 or 3 years. And many of them have even upsized their financing, which is really interesting. It means that the money is showing up again. That's really encouraging. I think it's going to point to a very busy summer this summer. I guess I do have a little bit of queasiness, and I'll tell you why. It's because everybody can remember 2020 and how everybody financed all at once and went out in the field, and the assay labs got jammed and the drillers got backed up. And I mean, it was just it was a traffic jam of activity for quite a while. Okay. And it actually was pretty painful to watch. I hope we don't go through that again. We have some really good stories. I'm going to talk about some of them today that are going to drill this year. And I want to see them succeed. I don't want to see a situation where everybody's dogpiled and can't get their drill programs done or their assays back or things like this. But, darn the torpedoes, here we come. All right, let's go to the next slide. Look, I have a good friend, Claude Bagette, who's a private investor. He has this web, I think this is his, this TradingView post is his. And he pointed out to me here recently that the TSX Venture Composite Index has indeed broken out. This is as of very, very recently here. So this chart goes back, it's kind of hard for me to see, but it goes back just a few months there. And you can see how it's formed. Well, as Tavi says, there are no triple tops. Okay, so it's broken through. Today, yeah, there's a bit of a pullback, but overall, it feels like we're starting to get out of the woods. No guarantees in life, but maybe this is a good sign. I don't know. I think one of the things, there's people that refer to bull markets as climbing the wall of worry. And while that's certainly true, I also see, I see a kind of metaphorical, like the way I think of it is like an anvil, somebody forging iron on an anvil. Okay. They get the thing red hot, bang away at it, shape it, get it red hot again, bang away at it. It's tempering, it's basically forging a blade or whatever they're making and then tempering it. Okay. Markets like what we're seeing right now, you see silver and gold kind of fall, but then they seem to catch a pretty strong level of support. It's the blacksmith banging away on it, and then it starts coming up again. And that's what we've seen over and over again here in the past few weeks. We see silver and gold kind of tip down, and then they find a support, and it's a resounding support. and they start climbing up again. Okay. And that's just the way it works. Nothing's a straight line. It's okay. Gives some opportunity for people who, are patient and willing to, persevere. And then other people who are just impatient and think, oh, that was fun. They can get out. But it's nice to see volumes and this breakout coming back to the TSX venture. All right, go to the next slide. Okay, this week Sitka announced what is really the first drill hole of this season. They have an aggressive program this year. They're going to do, 30,000 meters of drilling. And a lot of that drilling is going to be focused at the blackjack target. So they're, little refresh. They have a very large resource developing. I think they're up to 2.8 million ounces, some of which is in the Eiger deposit, and then some of which is in this blackjack deposit. And it's in the deeper part of the blackjack deposit where they started to encounter some higher grades in late 2023. They've been chasing that and very diligently drilling, to find out where this high grade goes at depth. I think there's basically a feeder zone coming up from below, the upside down cow model that I've presented. And I think this hole demonstrates that they're onto something. They really are chasing the grade, and that's what they need to do. Okay, 108 meters or 108.9 meters of 3.27. That's a tenth of an ounce gold, guys. That's crazy. I mean, that's wonderful. Now, a lot of people say, gee, that's deep. I can't tell you how many emails I get. Oh my gosh, it seems deep. Well, I got a slide here in a couple that hopefully I can put a lot of the concerns people have to rest. I'll show you why. Okay, go to the next slide. Here is the hole in plan view. So this is looking down on the blackjack deposit. There's a whole kind of cluster of holes. It's kind of like, think of it like spaghetti, stacked on top of each other. The hole that we're going to look at here in 3D is that one that's kind of dark. It's a little bit darker and more bold in color. That's the one they announced in this news release. And it does drill to the northeast. It's hit and probably crossed more or less the true width of, or the width of this gold zone, high grade feeder. It's very interesting how they're starting to see this thing take shape. I think, go to the next slide. I think they're starting to develop a vector on the grade. This is a cross-sectional view, more or less down the axis of the drill hole. So this is a northeast-oriented cross-section. We are looking to the northwest, and you can see a whole series of holes that were shallower above, but now we got holes deeper, and that's where our thesis started. Back when we first took position in Sitka a couple of years ago, was, hey, chase this big low-grade thing at surface down and let's see what happens to it. And they are, okay. They're hitting good mineralization. If you look at the broader interval of mineralization, it hit a big whack of, what was it, 1 point, actually, Trevor, can you go back one slide? Because I can't remember the number. I know it was in the title. Or go back 2 slides. All right, one more. There we go. You can see, 352 meters, I believe it says, a 1.55 gram per ton gold. That's astounding. I mean, this is kind of, valley grade, or, this is analogous to the valley discovery now at this point. I think this is very important. So keep going forward there. Go next. There we go. Right there. Okay. Here is the picture they're starting to see. They've got the resource, and the big colored blobs that you see there are basically the model resource at Blackjack, but they're also seeing the high grade forming a chute here. And I think they're confident this thing is projecting in a chute that's looking southeast. So in this case, our section is looking northeast, and the plunge of the high grade, they interpret the plunge to be to the southeast. Not 100% sure on that. I'm not going to be too critical, because they could be 100% right, but there's more going on here in my view, and I'm going to show you why. I'm actually going to go to the leapfrog model, and we're going to take a look at this. All right, so let's see, window. There we go. Share. There. Can people see this now?
Yeah.
Yep.
Let me wait a second.
It says it's showing.
Trevor, do you see it, Trevor? There you go. Got it.
Okay, all right, just a little bit slow today. Okay, look, the map that you see here is straight out of the news release. So this is the image we were looking at earlier, but I want to show you this thing in 3D. So what I'm going to do is I'm going to turn off that image, and we're going to look at the drill holes. Okay, and the one that you see in blue, which is this guy right here, that is your reported interval. Notice that that it's the lower part of this hole, this bit right here, that hosts that mineralization. Okay, and it is in amidst other drill holes in this area. It's not like it's, this area wasn't known to have gold. There's certainly known gold, but this helps them put the picture together. I think we're starting to see some continuity show up in the high grade in this area. But as I turn this around, one of the things I'm going to point out, while it would be easy to just say, oh, there's a zone of high grade developing here, look at over here. There's actually a drill hole from last year, I believe, over here that's hit high grade. How does this all tie together? There's still a little bit that needs to be sorted out. Okay, now right now I'm going to orient this. We're looking more or less northwest. Okay, so if this thing is heading down plunge to the southeast, yeah, these holes and that, yeah, they're all in high grade, but you got to ask yourself, why does this guy right here not hit high grade? It hits low grade, but didn't hit high grade. Okay, so as I turn this around, you see what I mean. Now we're looking at this thing in sectional view. And if the plunge on this thing is going in this direction, that interval right there is a little bit anomalous. Like, it doesn't support the thesis that this is going to the southeast overall. I think a little bit more study, a few more drill holes need to happen. Now, they do have a drill hole that's coming back here soon. I believe it's down in this area, something like this. So let's wait and see what they find. But the key is they are seeing pretty good continuous high grades starting to show up in this system. So that purple mass that you see there is certainly looking like a valley type discovery. A lot of work to do yet, but I think it's a major discovery personally. So very patient. I can't wait to see more assays, particularly this next hole that's announced to have a lot of visible gold in it. I think we'll see some exciting results. Okay, now I'm going to go to back to the deck here. Thank you. And go to the next slide. Now, to answer all the emails that I've gotten about how, this is deep and stuff, I actually grabbed this slide, which is off of a Cisco development. Okay, this is not part of Sitka in any way, shape, or form, but it does at least illustrate some mines in Canada. These are Canadian underground gold operations, and they happen to be bulk tonnage operations. And it shows you the grades of these things. The grades are in the neighborhood of, on the low end, Gold X, what is that, 1.7 grams? Okay, pretty low grade. Up to almost 4 grams in the case of Cisco's Caribou deposit. And all of these things are bulk underground. Okay, so the Gold X and this deposit that we're seeing take shape at Blackjack, I think, have a lot of similarities in terms of volume and perhaps even geometry at the end of the day. Agnico's making a lot of money. Look at the all-in sustaining costs for these things. Okay, all of these deposits make good money, and they have very similar grades to what we're seeing at and look, I've talked about this with even Scott Verdal. It's like, well, what have you found in call it a valley type discovery at depth? Could you mine it? Absolutely. In fact, if anything, it could be even more appealing in certain cases if the topography is too steep or stuff, to go underground and actually bulk mine something. I'm not saying that's the case here at Sitka, but these are good deposits and they will make good mines. All right, so that's the takeaway. Let's go to the next slide. Okay, Goliath put out a news release this week. Look, they've had a lot of research done around the Sherbet system, and this is part of the the Gold Digger project that they have up in the Golden Triangle in British Columbia. Sherbet is a very, very large gold system. As they drill more and more, they're just finding it, it keeps expanding, and they're starting to find higher grades. But last year in particular, they found a very clear, I would call it definitive evidence that the system, the gold system, is actually related to an intrusion. So a magmatic event that brought the gold up. And the gold seems to be very closely tied to that particular event. This is interesting. Okay, go to the next slide. Now, I'm not going to read through all these. This is part of the news release. I'd urge everybody that has a long time on the weekend to read through this and try to digest the dissertation that's here. But what I'm going to do is I'm going to go through and just highlight a few things. First of all, this study that was done by the Colorado School of Mines was all encompassing. They basically reviewed all the drilling and all the data that's been generated by Goliath. So it is all encompassing, very thorough work. I know the folks that did it. High grade mineralization. Yeah, we know about the classic Sherbet style veins, these very broad, thick veins that are relatively flat lying. But now we see a very, very compelling evidence that you have gold that's associated with magmatic dikes that have come up through as well, which are high angle. Okay, so now we have two targets basically. So the shear hosted zones that we know good and well, and now we have these, these stockwork zones within the dikes that are also apparently high grade and have that direct magmatic connection. Okay, yes, there are stacked veins here. We've now found a lot of different veins. They quote 12 different veins that they found. Many are very high grade. In fact, last year they started to really focus in, find that high grade core to the system, particularly around the Bonanza lode. And I think we're going to see the company focus like a laser on drilling up that high grade this year. Go to the next slide. Okay, now this gets into the world of esoteric. Okay, but anybody that's a geologist in BC knows that the deposits in the Golden Triangle typically fall within a certain range of ages. Okay, and those are back in the 100+ million year range. Okay, I'll just say they're older. Okay, well, this work that was done by these folks at School of Mines actually dated the mineralization, and what they're finding is the gold in this case at Sherbet is actually related to a much, much younger magmatic event. It's dated at 50.7 million years. It's what we call Eocene in age. Why is that important? Well, this is really the first definitive evidence that you have an Eocene mineralization event occurring within the Golden Triangle. It's really taken the blinders off a lot of people's eyes, and now they're thinking, wait a minute, you have this here? Maybe there's more of these. I think, it got me to thinking when I saw this data, even SK Mining, the high grade that was found late last year at the south end of the property, those veins apparently are very closely tied to an intrusion down there. So I've talked to the guys that we're going to have do field work out there and collect samples. I want to see if that's an Eocene intrusion. Okay, maybe this juggernaut thing that they've discovered, maybe that's an Eocene intrusion. There's a whole world of new thought going into this. Okay, I'm going to spare you the rest, but basically, this data says that we have a new beast in the Golden Triangle, and people may rethink how they explore even based on this work. Very good analysis. Go to the next slide. All right, El Oro put some news out here. Some more drill holes. These are infill holes, and I think they're very important. Any infill drilling they do at this stage is critical to build up a solid resource base. Now, I'm going to do something really weird for everyone. I realize we're running long. It's been a long, but I hope people can be a little patient here. I'm going to show you two models. Okay, I'm going to show you El Oro, and then I got a secret surprise. Okay, share screen. There we go. Windows. Okay, hopefully that's popped up.
Yes.
Okay, this is El Oro. This is looking down on their news release, the map from the news release, this image right here, and this red oval that they have, that is kind of their core high-grade area that they're focused on. They want to infill that and basically come up with a more advanced, confident resource that they can put into a starter pit. How much tonnage could you fit into a pit like this? I think you could probably stuff 150, maybe with luck 200 million tons in that general area. Okay, and infilling this data is critical because as they infill, it helps answer the questions of whether there is grade in between some of these widely spaced holes that were part of the original resource. The more data, the better the outcome. Okay, it's that simple. Now, the two holes that were in this news release are these blue dots that are over here. They're kind of teal blue there and there. One thing I'll show you, the scale bar that's in the lower right, as I zoom in and out, it changes. Okay, so you can freeze your frame and just check it out if you want to on YouTube, whatever. All right, what I'm going to do is I'm going to turn off the image real quick because that's kind of bogging things down, and we're going to look at the drill holes. You can see right away, just from color and intensity alone, there is an area right through here where the drill intercepts, look at these, are nice, solid, long drill intercepts. And many of these holes, most of these holes through this area have very, very stout silver polymetallic intercepts. And that is why they're focused on this area. Okay, this is critical to get this right because this is where your mine is going to start. Now you might say, well, that's fine, you know, that's cool. But what about all this stuff down here? Or what about all this stuff up here? Look, I've made this argument multiple times. When you have a project like this, you want to start with a mine. If you build a mine, okay, if they were to come in here, identify 150 million tons that they can convert into reserves, that makes a great mine, we're off and running, because then you can capitalize the mine, build it, make some money, and then you worry about the rest of all this stuff. Okay, there's heaps more stuff here, over here and over here. And yes, at some point, this whole thing will probably fall into an ultimate mine, but you got to start somewhere. Okay, and in the mining industry, we've kind of lost our way. I say they focus like a laser on this right here, get this piece into a mine. I'll show you what I mean by that. I'll just cut a quick cross section just so people can see what I'm talking about. I'm going to cut a section right down the guts of it right here. Okay, if we tilt this up on its side and we zoom out a little bit, look at the mineralization here. It's nice, solid mineralization. You don't see a lot of black gaps in the drill holes in this area. It's pretty consistent. Okay, this is going to make a decent open pit, and it's where you start. What do I mean? Okay, well, I'm going to show you something that's we'll say we're going to do Back to the Future here. We're going to look at a mine that's not far away from El Oro here that we know good and well. Okay, that's actually been mined for about 15 years now. This is San Cristobal, and we're looking down. We're looking towards the southeast here. We're looking down at the pit. All of these little white pixie sticks you see here are drill holes that were drilled at the time that the deposit was drilled out. Okay, I'm going to tilt this up very gently. It's a very big file, and you can see that there's a lot more going on below here. Okay, now we bought this about 2.5, 3 years ago now. And one of my big pushes has been for the folks here at the mine to drill. Okay, we need to find more ore. I want to have a long future to San Cristobal. Okay, so where are we starting? Well, this area right here, you can see lots of red and stuff. These are drill holes that have been completed in about the past 6 or 8 months. And we found massive extensions of the ore out into the wall of the pit. We're outside of the pit. This is the pit over here. This is way outside. We might have found years worth of ore. We might have another 6 or 8 years, maybe even more, maybe 10 years if we're lucky, of ore. And as I spin this around, you see there's actually some very high grades in here too. If I zoom in, I know this is probably making some people dizzy, but look at up here. Look at where this purple is up here. There's very high grades just outside of the pit. Okay, this is how ore bodies work. Okay, this is now 15 or 16 years into the mining of this pit, and we're still finding ore. Okay, so this is kind of analogous to the stuff that would be outside of the starter pit that El Oro has. You know, you develop mines gradually over time. You drill, find more, drill, find more, until you just can't do it anymore. Okay, and that's what we're doing here. This is a delightful outcome for us. We've already found multiple years worth more ore. You can see even right below the pit here, we found some. As I scroll along, by the way, we're looking northwest. Even in here, which is interesting, you can see there's a bunch of high grade tucked right there underneath the pit. Yeah, are we going to get that out? Heck yeah. Okay, this is ore. This is low hanging fruit for us. I could spend all day showing you this. There's a a pretty good high grade zone tucked in right there. Look at that. Look at, holy guacamole, you know, very high grade stuff right in front of God and everybody. Okay. We have a lot of low hanging fruit. We're going to drill the bejeebers out of this place. I'm known for kind of pushing drilling in excess. Look at this, guys. Holy guacamole. This is an old portion of the pit that was abandoned 15 years ago. Okay. And look at all the high grade underneath there. Just an absolute ocean of high grade intercepts. Are we going to find more ore? Heck yeah. Okay. We got a multi-year future. But the point I'm trying to make is El Oro needs to build a pit on what they have in front of them and worry about the rest of that stuff. It's a tomorrow problem. Okay. Get off, you know, get focus like a laser. Get the infill drilling done. Put a PFS together, then a BFS, whatever. Get this thing capitalized and get it into production. That's how you create value. All right. Okay. Now we're going to go back to this slide deck here. Go for it. I know I'm going long. This is a tough week. Look, real quick note. Snowline has expanded their leadership team. Look, I'm having trouble because for some reason this image today, like my little screen, I think it's because I'm on my PC today. I can barely read anything, guys. It's so bloody tiny. But basically, they've expanded their operational team. They now have a VP of engineering. Is this a company that's just going to sit on the sidelines and wait for somebody to acquire them? No, they're taking all the right steps. They are going to work towards developing the Valley deposit. I think these kind of moves are always a good sign to see in a company that has a massive world-class discovery, and I'm glad to see them make this move. All right, go to the next slide. Altamira had some news a couple of weeks ago, I believe, and it's about the expansion at Cajueiro. They keep finding more stuff, okay? And really this is turning into, I call it a Brazilian version of Sitka or something like that. Like it's basically an upside down cow, you know, the cow udder model in Brazil. All right, now let's go to the next slide. Now, what do I mean? Look at all these gold targets they have now. Yes, we know about the historic work, you know, in that white area, the Cajueiro mineral resource area. I think it's about 700,000 ounces inside that white box. But now we know there's a gold system at Maria Bonita. But look at all of these different gold systems they now have. They have a whole slew of these things scattered across their property. Okay, each and every one of these is going to add, you know, maybe a few 100,000. I don't know, maybe 500,000 ounces here and there. Like you're going to see all of these things come together. It's the upside down cow, okay? And each one of these is going to be a significant deposit, in my view. They've got to get out and start drilling. Okay, they've got the soil data and other data coming back. Great stuff. Go to the next slide. They found rock in outcrop. This is a beautiful sample of silicified breccia. Why do I put it in here? Because it's a cool looking rock, and it has gold in it. Okay, it's basically telling us that there is a giant porphyry gold system here. They need to get drilled. Okay, this has got to be the year of drilling for Altamira. They got to get back in the saddle and drill. I think this is. I've seen other stories get financed recently, and I'm thinking, my gosh, Altamira is head and shoulders above a lot of them. Okay, these guys need to just pull the Band-Aid off. Go. Let's go to the next slide. Onyx. Look, we put money into Onyx way back when they first founded. I think 2 or 3 years ago. They have a project in the Yukon. I knew they had the one back in Ontario too, this Monroe Crisis deposit. But, much of their focus, I should say, has been on the Yukon. Now, they did decide to drill back at Monroe Crisis here recently. And lo and behold, they actually snagged a pretty good interval, 3.4 grams over 70 meters, more or less, with a higher grade interval. In fact, some of this is actually pretty high grade. There's 3 meters in there that are north of an ounce per ton. Now, what is this? Let's go to the next slide. Look, this is, firstly, it's in the Timmins camp. Okay, so this map shows you where we're located. This is part of the Timmins goldfield, okay, which is important because if you think about it in that context, you can't swing a cat around here without finding a 1 million+ ounce deposit. Now, do I know how big this is going to be? Look, I know what the company's presented investors with, and it looks interesting. I'm not going to say I have a definitive, view on where this is headed, but this for a first stage drill hole, this is pretty darn interesting. Okay, go to the next slide. Here's a plan view. The drill hole that is in the one to highlight is the one that goes to that yellow zone. They actually hit the gold up in the northern part of this property in an area where there's been no drilling. So you can see what they've hit is wide open. It's open along a strike, which would be east to west. It's also open north and south. It's basically open in all directions. Yes, there's been drilling here in the past, and it's hit some decent mineralization, but this is a brand new discovery. Let's look at it in section. Go to the next slide. Okay, you can see in cross-sectional view, there we go. They were drilling these holes across the known gold zones. That Argus zone, the brown linear things, were the known target. But in this case, they happened to let this hole go a bit longer. You can see it extends a bit further than other holes that were drilled in this area. And lo and behold, they've hit this Argus North discovery. And, this is how discoveries are made. That's a beautiful discovery. What is it? Don't know yet. Okay. The core photos that I saw, interesting stuff. It looks very classical Timmins type stuff. It's an orogenic gold system. But I'd love to learn more about this. Maybe I'll talk to the company here soon, find out if maybe there's some link with magma that's associated with this too. I say that because some of the photos I saw kind of look like the Preston Porphyry over at the big open pit at Timmins in the Porcupine Camp. Look, this area's heating up again. What was it? Discovery Silver now should be named Discovery Gold. But the Porcupine operation from Newmont and Timmins is getting back in gear here. Future of gold in the Timmins belt, I think, is really good. I think this is an opportune time for a discovery like this. Let's go to the next slide. Okay, this kind of reflects on my first slide that we got a lot to look forward to this year. Like, we have a lot of companies that will be active drilling and doing other work in the field over the season. One of the more exciting ones, I think, is Juggernaut. I know some people say, well, lightning can't strike twice, and but look, I think one of the things you got to reflect on is that some of the guys who work here at Juggernaut are some of the same geologists that basically found and have now advanced sherbet at Goliath, over the past years. So they have a very different way of thinking about exploration in the Golden Triangle than most other geologists. And they've gone out and they've identified what could be another sherbet type target here. And the size of these veins is absolutely jaw-dropping. I mean, look at that. That's 4 meter width. There's a guy standing there, a geologist, 6-foot geologist standing right there. It gives you a sense of scale. These are absolutely immense veins. And look at the grades. Very much, very, very similar to what we've seen out of sherbet. Could this be another sherbet type? Could it be tied to an Eocene intrusion? Well, I saw some samples at PDAC. They were kind of saying, maybe there's a porphyry. I'm like, no, that looks like the intrusion at sherbet. I'm seeing a connection like that. Maybe a reduced intrusive gold system with these associated lodes. Wouldn't that be a cool outcome? Lightning might strike twice. Quite frankly, the flavor of mineralization being gold with some silver and a little bit of base metal, copper, lead, zinc, very, very similar to sherbet. Okay, go to the next slide. Here's another vein. What is this? This is 8 meters thick. Look at that. Look at the geologist in there. That's crazy. 16-gram gold equivalent. What's more to say? I mean, that's incredible. If you found veins like this, they don't just go, we'll go a few meters and stop. Veins like that, those are big boys. They tend to go a long way, both laterally and vertically. My hunch is these guys are onto something pretty special. And when I talked to Lele at PDAC, he was equally as fired up about this as he's ever been about sherbet. So say no more. Let's go to the next slide. And look, they've got their government approvals and they're ready to go to drill the porphyry targets at their Valiente project. Now, This is not Provisto that they're going to drill. This is Bellin, the Bellin prospect, where we have multiple porphyry centers. These are porphyry copper gold centers. First time this has ever been drilled. This is true greenfield level discovery, and they've got their permit. Okay, now, firstly, great. It sounds like you're going to start drilling. That's exciting, but it also means that getting a permit for Provisto, which is not far away, should also be manageable. We now know that the company has ability to get permits. I think it's very important. Okay, go to the next slide. So another story to look forward to, guys. I'm trying to tell the world spring is sprung, and the drills are going to start flying. And here we go. Okay, Tectonic. This is actually the news release from a few weeks ago about the drill hole they have in the Alpha Bowl area. Yes, Tectonic needs to get their proverbial poo in a pile and get going. I want to see the company drill their living butt off this summer. I don't want to see them start late. I want to see them start as soon as humanly possible and get back out to Valley and drill some holes. Excuse me, I said Valley. Whoops, Freudian slip. Get back to Alpha Bowl and drill some holes. Now, why? Okay, I'm going to jump off and I'm going to show you the screen share again because we got to go through a refresh on this puppy. All right, we got to show everybody why we're excited about. There, come on, share you darn thing. Okay, let's go over here. Where is it? Okay, there's Tectonic. There we go. Can you see it?
Yes.
Okay, look, this imagery comes out of that news release that was about a month and a half ago or two. And I'm not going to beat this up. What I want to show you is most of the drilling to date has been down here around Chicken Mountain. Right? There's gold in every hole. And yes, there's probably going to be a big resource here. Generally lower grade. I'd love to see them find high grade. Okay, and I've said that from day one. And I think they have it at Alpha Bowl. So what I'm going to do is turn the surface stuff off here. Whoops, I got to turn 2 layers off. Hold on. There we go. We're going to focus not down here at Chicken Mountain. We're going to focus right in here where there's just a handful of drill holes. In particular, we're going to focus on, oops, this bad boy right here. Okay, there you go. That's our drill hole right there. This is our 65-meter hole that ended in mineralization. Okay, did not stop. This hole over here, oops, sorry. This is the one. Sorry. This one ended in mineralization too, but this is the higher grade one. Okay, this guy right here. Do you see any other drill holes around here? No. These two are kind of way out. They actually have gold in them. Okay, so it's not like these are barren. But right there, you got a high-grade intercept and absolutely nothing else around it out here. Now, what do we know about this area? Look, we know that the placer, see this pink blob here? There was a humongous placer deposit in here. Hundreds of thousands of ounces of gold came out of this drainage right here in Alpha Bowl. We now have an explanation of why all this gold was in this placer. It's because the deposit's probably sitting right underneath here. Okay, so a systematic drill out of this area with a few deep holes could produce a valley. Why do I say that? Let's look at scale. I'm going to turn it. So now we're looking east, kind of. Okay, look at the scale bar down here. Okay, right now that scale bar, about 750 meters, that's about the size of the length of valley, the valley deposit. Okay, we need to drill the bejeebers out of this place and drill it deep too. I want to see like 300, 400 meter holes, and let's see if we can find the next valley in this area. We know there's a ton of gold coming out of here. We have a hole right there that's jagged 65 meters or 1 point whatever gram, like 1.3, 2 or 3 gram, I think it is. It has to be done. Make it so, please. Okay. All right, let's go back to the slide deck. Go to the next slide. There we go. Intrepid has announced they have received permits so they can expand their exploration activities at Corral Copper. What do I want these guys to do? Look, they drilled a lot of holes about a year ago, and they had great results. And they were not as too surprising results because there had been drilling in that area before. Okay, now what I want to see is them apply all of the technical work that was done by people that I know work for them and have done a good job on the technical side to develop new targets. And I want to see these guys take some bold steps and try to find the big prize here. What they have to date, great results, very high grade, good copper, good gold. Let's find the rest of this thing. That system that they have is not a one-off. Okay, Mother Nature does not do that at random. There's something bigger going on here. I've talked before about how this is analogous to another mining district in Arizona, and it's basically an IOCD system. It's not a porphyry, which is interesting. Bisbee, and I think that this one has that kind of flavor. Okay, and I want to see these guys find the big prize. All right, go to the next slide. By the way, without saying, most of these companies have money. That's the whole punchline here. These companies are going to be rocking and rolling this year. Okay, now Puma took a different strategy. They actually have teamed up with Kinross. They have a $2 million program that's going to initiate here shortly. And it sounds like Kinross wants to go out and open up a lot more trenches over the Williamsburg Brook area and see if they can't find more discoveries like the Lynx discovery. Basically, just rip the place apart and see what's going on. Yes, they got many teams going out in the field. They're going to do a lot of mapping, sampling, trenching, things like this. But maybe later this year, once they find some more discovery, they can start drilling again. And we'll see some drill holes both at Lynx, but also new discoveries that they might make. The nice thing is the company doesn't have to raise money to do this exploration. Kinross is putting it in as part of an earn-in. All right, let's go to the next slide. Yukon Metals. Look, they've had 2 news releases just in the past month or so about drilling. One was at Star River. I talked about that a couple of weeks ago. This announcement, which came out recently, is about the Birch property. And this is over in the western Yukon. Very large copper anomaly. Copper, and there's some gold as well. In fact, high grade. I talked to Ron Burdall. Ron's the dad. Scott's the son, and Ron's his father. And this collection of projects was from the family's portfolio of projects. These are basically the base metal version of the Snowline assets. All right, and this one, he really likes the target. I think it's a robust target. Do I know exactly what it is at this stage? No, not really. It's perhaps a skarn system that's associated with maybe a copper gold porphyry. Don't know, but big anomaly. They're going to do some field work and get in there and start drilling. So this is going to be a company that does a lot of drilling this year. They have the money. I'd love to see them succeed. Maybe they'll find a base metal gold version of a Snowline. Let's go to the next slide. Okay, I think that must be it then. Thanks, guys.
All right, we finished on time. Fantastic. So as you can see, we have a lot of our companies are going to be drilling and are cashed up. It's been unreal to see. I mean, just a month or two ago, it seemed like there was no money at all coming into the exploration space, and lo and behold, people showed up. So spring is here, and our companies, many of our companies, are cashed up and ready to drill here in North America, at least for this drill season, and it's pretty darn exciting. You'll note we talked a little bit about how the Trump administration has just made gold a critical metal, along with basically every other metal, critical metal. Yeah, they want to go after rare earths too. Rare earths are kind of silly. Quentin can tell you more about that another time. But we have a number of U.S. stories as well in our portfolio that could be beneficiaries of the Trump administration, whether it's Western Alaska, Tectonic, Silver 47. In Arizona, we got Falcon Butte, we got Barksdale, we have the entire Butte, Montana, half of the entire Butte, Montana silver and copper district in our Silver Bow mining company, a private company in our fund, and a number of stories. BCM, which is in Utah, Quentin and the team at Colorado School of Mines think they have made a discovery already, a copper gold porphyry, another Bingham Canyon style potential discovery. We've got other names here in the U.S. in our portfolio, and And these are critical minerals, whether it's copper, gold, silver, zinc, and lead. I mean, the world needs this stuff for civilization. And with the rebalancing of the economy that the Trump administration is trying to engineer, back to industrialization, rebalancing towards more manufacturing and critical minerals, this is a blessing for our portfolio. We've gotten in ahead of this, and we have a number of cheap stories that are getting ready to drill. I've never been so excited about the portfolio that we put together and the opportunity here ahead. If you're interested in learning more about our strategies, please reach out to Merrick. His contact information is right here. Tavi, any final remarks?
Well, the final remark, I guess, outside of the fact that it is important to see how gold continues to be bought even the days that it's been challenged as well in terms of corrections in near term. The gold was down significantly more coming into the day, and it just keeps improving, which is clearly a sign of accumulation over time. Same thing happening with the days that we're seeing down days in gold are not really marked with huge days on the negative days on the mining space either. So it is an important behavior that we're seeing on the metal, of which perhaps we're about to see some of these high beta plays like the miners, the junior miners, and especially the other metals finally start to catch up and do a lot better. Some people didn't even know GDX has actually outperformed the S&P 500 with dividends in the last 10 years, which was, to me, it shocked me as well. But anyways, I think there's a lot more to go. This is just in the seniors. If you look at the juniors, it's still massively underperforming, which is, in my view, where the real opportunity is, along with the explorers. So, all right, well, let's finalize here. We'll be back in a few weeks. If you have any questions about Crescat, you can contact Merrick. In the screen is his contact information with email and phone number. If you enjoyed these videos, you can follow us on Twitter or X or YouTube as well. And thanks, everybody, for watching. It was a pleasure. Thank you.
All right. Thanks, everyone.